Okay, so what is this a clip about? We're about
Okay,
to
so
view.
this is the Money Guy show, and they're going to talk about investing advice that they're giving, just general kind of investing advice.
A general sort of.
Yeah,
Okay.
and these guys are both certified financial planners and chartered financial analysts. They have a pretty good idea what they're talking. They know what they're talking about, but they're not going to get into what the risks are or why these things are bad. So we're going to take what they say and then we're going to elaborate a little bit.
All right, let's do it.
All right.
Okay, I see something here. I said, how did you choose these funds? She goes, I chose everything that had the word growth in it. I want my money to grow.
So he's talking about a woman when he's talking to her about her account, and she's picked all these funds, and she picked everything that just
in it. Is that what he's saying?
Yeah, the word growth. So she picked all these funds that were growth funds.
I kept not hearing the word. I thought it was group. I was like just looking for companies with the word group in it. I was not catching that.
Yeah, he was not. It took me a couple times, but that's why I'm positive. So he's talking about the woman just picked everything that had growth in it.
Retirement. So I chose everything that had growth in the title. And I was like, you realize all 6 of these funds probably buy the exact same holdings. They're all closet S&P 500 funds, essentially. So she had no idea that she truly didn't have any diversification because she thought having 6 different funds with 6 different names with 6 different versions of saying growth was giving her diversification. No. So you need to understand that what does your...
Okay. So that's another good point in risk. So if I pick 6 things that are practically identical, right, I haven't improved my risk because they all pretty much have the same risk.
Right, you've replicated it.
Yeah. I could have just picked one and been pretty much the same position, right?
Right.
So there's an idea called diversification where what I'm doing is I'm picking different things that have different risks, different returns, right, that behave differently. And the idea is that if I do that, if one makes money, one will lose some money. But if that one loses money, that'll make money. And over time, I'm consistently making more money, right? They don't go into this. Diversification gets thrown around a lot, and it kind of gets misused.
I'm feeling like we might need to do an episode specifically on trying to define diversification.
I'm going to do a quick 2-minute thing here. I'm not going to go into like the math behind it. I'm just going to do a quick concept. So there was this guy in the 50s named Markowitz, and he developed this thing called efficient market theory and this thing called the efficiency frontier.
Right.
And then a guy named Fama and French came along. So they've all got Nobel Prizes for this. So the idea is don't focus on the straight line. Focus on this curve. Okay? So these little yellow dots are individual assets, right? And on the vertical here is the expected return, right? We don't know for sure what the return is going to be, but this is sort of what we would expect, right? The bottom line is standard deviation. That's the risk we're calculating, right? So this is risk. This is the horizontal. So we're assuming this yellow dot here, for example, has this one here, this first one here, has this much risk for that much return, right? But this yellow dot up into the left of it has a higher expected return for a lower risk, so it'd be a better investment. The idea behind proper diversification is if you mix enough of these together, and everything underneath this curve would be the entire markets, all the markets. If you mix them properly and diversify it properly, you should get somewhere on this curve, which is the best expected return you can expect to get for the least amount of risk. That is the concept behind proper diversification. The quick example of this, and this is a market portfolio versus a portfolio I built years ago. So person 1 is the market portfolio. Person 2 is in my portfolio. Okay. So this is the market return for 10 years. My return was different for 10 years. In fact, it was a little bit less because my standard deviation, my risk, was half that of the market. So the market's was 20.09, mine was 10.05. So what that means is, and we'll get into standard deviation more later, if the median return or the average return is 5%, right? The market return in a normal year could be anywhere between 20% above that, so 25%, or 20% below that, negative 15. Mine, on the other hand, I'd squeeze the risk down to a 10% distribution on either side. So at a 5% same mean, right? Mine could go from any year between probably 15 to negative 5, right? So it didn't have necessarily the high ends, but it didn't have the problems with the low ends. And as we discussed earlier, it's harder to make up money once you've lost it than it is to preserve money going forward. So if you look at the basic return on $1,000 was all I did, just to throw this in there. My portfolio at the end of 10 years had 1,756, but the market return portfolio only had 1,509. Even though it was getting larger returns, it was also getting lower returns in the lower market, in the down markets. So I didn't have to make up as much money over time. So the average return on that portfolio was 4.2, as where mine was 5.79. We both had the same average return, right, of a 6.25. And the beta is just how they fluctuate together, and I'll get into that a little bit more later. But you see, just by squeezing down the risk over a long period of time, by squeezing down the risk and diversifying, I can beat the market, but I need a long period of time to do it. Diversification does not work in the short run. You need 5, 10, 20, 30 years. And if you do it properly, you can always consistently beat the market over the long run. That's why these guys won Nobel Prizes for this theory, because it works. And it's pretty much always worked. I mean, there's very few situations where it hasn't. So that's the general concept behind diversification. But like he said, if everything is a growth fund, right, then you're not diversified, because you basically got 6 of the same things, like he said. When you want to have, probably in like my portfolios, you want to have at least 30 or 40 different things that are doing different things to hedge each other out. But essentially, that's what a financial analyst is doing, is when they're creating a portfolio, is they're looking for, how do I squeeze down the standard deviation risk? So I'll just show this real quick. So this is just the graph of the two. So the person 1 was the market, and person 2 is my diversified market portfolio. So as you can see, they had larger down dips than I did. So mine had a much more consistent growth, because I didn't have to make up losses as frequently.
Mm-hmm.
Does that make sense, or is that trying to keep it?
No. I think that's clear. I think we could zoom in on diversification in a future episode, but I think for the sort of quick tutorial version, that's good.
Yeah.